All right, some of you, I'm sure, are back from the stream that we just did at 11:30. I appreciate you all for showing up. We are going to talk about, first off, how we call the tops and bottoms on these markets, right? How we catch trends. We're going to talk about the methodology behind it. We're going to tell you exactly what you need to know, like what actually moves the markets, okay? Because ultimately, there's some serious stuff that moves the markets that most people don't realize, that most people don't know about, and we need people to understand this. And I'm also going to showcase the indicators that obviously do that for you. So welcome to the Alpha Intelligence monthly AMA. We missed last month because it just got super busy, but we do this. It's going to be probably the second to last Friday of every single month, where anybody can come in, they can ask any questions they want about the indicators. They can, pick things up. They can, say, hey, I want you to look at this asset. I don't understand this concept. How do I use this indicator in this certain situation? And what I also do is I teach you the methodology. I teach you what are order blocks, what are fair value gaps, why do they matter so much, and why does the volume of those order blocks and fair value gaps matter so much? And then how do you interpret that data, right? How do you interpret that data and make it actionable? Then we also will be talking about market structure. We'll be talking about highs and lows. We'll be talking about swing failure patterns and reversals. We'll be talking about how you can couple that with other confluence and data like swing failure patterns being, coupled with opposing divergences, or the order blocks and the institutional levels of support and resistance and things like that. We'll tell you and make you understand kind of how VWAP works, how the naked VWAP levels work, because those are naked institutional levels. We'll tell you what they mean. Same thing with the naked POC. So we're just going to get straight into it. This is going to be jam-packed. Like, if you don't understand what I say on my streams or inside of the Discords or whatever, and you don't understand why I'm, doing the analysis that I do, and I say order block, or I say fair value gap, or I say, naked level, or market structure high or low, or swing failure pattern, you're going to understand all of that by the end of this AMA. That's the good news. Now, we did have a lot of people that have signed up for the indicators, and that's why I'm making this public, because I want to make sure that everybody knows that this call happens. Because a lot of people, you get an email about it, but you might not necessarily know. And I post it in the Discord, obviously, right? But you might not necessarily know about it. So with that being said, the first thing that we're going to jump into is the flagship. It's the one that, in my opinion, this is my opinion, okay? In my opinion, this one matters the most. And we're going to talk about order blocks first, okay? Order blocks and fair value gaps. It is the bar none, bare minimum, absolute, probably most critical and crucial thing that you need to understand and thing that you need to have on your chart. And spoiler alert, and this is why it sucks, but that's why I automated it. It is the most manual thing. And that's why we invented Order Block Suite, to make it not manual for you. We want you to be able to automate this so you can spend your time trading and not actually charting, okay? So what is an order block? All an order block is it is an institutional block of orders. It sounds like exactly what it is. Order block, it's just a block of orders. Now, this is a block of orders, and I'll show you live on the screen. This is a block of orders that happened at a certain point in time, okay? The one thing that institutions cannot hide, volume. They can spoof order books on the live tape. They can spoof and, put orders on and take them off in rapid succession with their bots and algorithms and stuff like that. But the one thing they can't hide is the actual buys and sells that they already did, the real money that already moved. And that is what this maps out for you, okay? So, and we're going to go to the NQ chart. We'll make it so that you can see like really, really well. So what this order block right here, this is what the order block looks like, right? What this order block is telling you is that institutions sold a bunch of NASDAQ futures contracts right here, and then price pushed down, okay? This is going to serve as potential resistance in the future. Now, the good thing about the order blocks suite, it tells you the time frame that that sell came in on. So for example, this sell is 306,300 contracts. It probably costs about, is this micro NQ? Probably costs about $5,000 per contract. It's about $1.5 billion in shorts that came in at this exact level. Now, why does that matter? Because this confluence bubble, and again, you can access this anytime that you want. You just look at it. You just scroll your nice little, mouse over it. And it's telling you that from a 45-minute, a 1 hour, and a 2 hour perspective, $1.5 billion worth of short volume came in at these exact prices. The cumulative price range is $3,021 up to $3,124. So within a $100 price range, $1.6 billion essentially worth of shorts came in. Now, obviously, it's worth more than $1.6 billion because it costs about $5,000 to hold one of these MNQs overnight. So it's going to be worth a lot more than that, but for the margin that came in, it's 1.5 billion. Okay. So this is going to be massive institutional resistance. Okay. Because of all of that volume. Now, the one thing about the order blocks is that this is telling you where they actually sold. Okay. Whenever they come back up here, they are likely to defend their positions and push price back down, or it being a block of orders and a big, massive displacement move down, what is more likely is that they still have orders placed here on the live tape, and then you fill those orders and it pushes it down, okay? So they're either going to, one, most likely, defend their position at this level, or two, add to their position at this level and push it back down again, which is why you see resistance and support when you come down to these levels. Boom, boom, boom. Because as you can see, this was a long level where they purchased 350,000 contracts, about $750 million worth of, let's see. No, it's more. It's $1.7 billion worth of volume came in here. So if you're wondering, why did the NASDAQ bounce here? Why did the NASDAQ bounce here? That's why, because the institutions positioned massive longs here. Then this is a prime example of what happens. When it came back to that level that they positioned at, guess what they did? They defended and then added to their positions and pushed it all the way up to the next set of order blocks, right? And then it finally rejected. Now, I'm going to show you why it rejected here, but we need to get through order blocks first. Now, what that order block is essentially telling you is this. When those institutions positioned there, they're showing you their hand. They're showing you whether they went net long or whether they went net short and the exact amount of money that they spent at that level. They're also showing you that, think about it, you're an institution. You have $500 billion in assets under management. Do you only want to buy a $1.6 billion position? No, of course not. You want 10 billion, you want 20 billion, but you know that you can't buy all of that at one level like we can. We can just press the buy and sell button, right? But institutions can't do that. They have to get filled over time, right? So that's exactly what they did. They got filled over time. They took 1.5 billion here. They added to their position here. After it pumped, they pumped it back up. They finally got out of their positions up here. We know that this is where their position average is, and they were probably legging out right here, right here, right here, maybe even here. And they're trying to get out of the rest of their positions down here, right? At a profit, or at the very least a break even. And now they are defending the positions that they built right over here, okay? So that's essentially what the order blocks suite is telling you. It is what I would call support. Let me see. Supply and demand on steroids. It's like the support and resistance of support and resistances. The main difference in between order blocks and just like random stuff is that we base it off of mathematics. It's not just like, oh, this is a arbitrary level. No, we want to know how much volume traded there, and we want to be able to use that volume to make decisions. So the more volume at that level, the higher level the resistance or support is going to be, the more likely that price is going to do one of two things, okay? And I'll give you both examples. Either one, reject, or bounce, right? Or something like this happen. There was an order block right here on gold, and all it did, and I'm going to zoom in and I'm going to show you, the order block was literally right here, okay? And all that order block did, because it was a smaller order block on a smaller time frame with not super huge amounts of volume on it, what that order block did, it didn't reject price, it served as a take profit target, okay? And it slowed price down. As you can see, once you came up, and again, this order block has now been mitigated, but once you came up into it, it stopped price in its tracks before price built up enough momentum to then move up above it. You'll likely see that happen on gold at this 2-hour order block that only has 6,600 contracts in volume on it. You'll probably see the same thing. Maybe even a little bit of a rejection, and then it'll move through it, right? So my point in saying this is that the larger the volume and the more time frames that agree at the same place is going to be the larger the resistance. Look at this one on silver. 10 order blocks all at the same place with 80,000 in cumulative volume on it. It costs at least $20,000 to hold a full silver futures contract overnight. It probably costs a lot more than that, to be honest with you, but we're being conservative here. That is $1.6 billion right here worth of institutional resistance. You wonder why we're kind of stopping here? Well, there was an order block right here, right before it. So it's going to slow price down. And this is likely to absolutely reject price. Okay, price is very likely to reject here on silver. Why? Because the order blocks are there showing you exactly where institutions positioned in the past with their volume, live volume that has printed, not fake volume where there's, oh, this is a pending order. No, this is where they actually did business. Okay, that is why order blocks is so critical. Now, the one thing I will say, order blocks come with what is called a displacement candle. And I will show you what that looks like here in just a second. If I zoom in on the chart, I can show you this exactly. Actually, we'll do it on silver. And we will let the chart zoom in just a little bit. And we're going to turn off alpha structure for this. That way, we don't get any noise on our chart. Okay, so this was your order block candle. You can actually see the box that is formed here. Okay, what that order block candle did, and let me share the screen for all the people on YouTube. This was your order block candle, okay? And you can actually see the box that kind of went from that order block candle, and it started, as you can see, on that candle, right? Now, what happened after that is what's called a displacement candle. This candle is called a displacement candle, the big blue candle right there. That is a displacement move away from the prior range, okay? See how it broke the prior range? That is called a displacement move, okay? That's meaning conviction in price movement, okay? So they literally pushed price down, built their positions here, and the institutions pushed price up. Now, what happened in between candle one, which is the actual order block candle, and then the displacement candle is what is called a fair value gap, okay? I call it a displacement zone, but everybody knows fair value gap, so I just use fair value gap as I just say it because that's what everybody knows, okay? Now, sometimes what will happen is in trending markets, you will not come back to the actual order block itself. You will only come back to the fair value gap and bounce. Now, when does that happen and when do you need to pay attention to that? When the market is aligned in a trend in a very significant capacity, okay? What do I mean by that? Alpha structure, the indicator that you have access to if you subscribe to the indicators, Not only do you get order blocks, but you also get alpha structure, you get naked VWAP, you get naked POC, right? Alpha structure shows a box up in your upper right-hand corner, and we'll show it to you. Let me go ahead and share the screen again. It shows this little trend status box up in the upper right-hand corner. It'll be right up here. That is going to show you the trend across 10 different time frames. So from the monthly down to the 1 minute, you see the trend. So when you see something like this happening, where you have the short-term and midterm trends like the 1 minute through the 30 minute as short-term trends, and then the midterm trends like the 1 hour to the 4 hour, starting to align with the long-term trends, and they're shifting to an uptrend, or they're shifting from an uptrend to a downtrend. That is what is called a trending market. Those are going to be the markets where you're not going to get to come perfectly inside of the order block. Those are going to be the markets when they're trending that you're likely to have to adopt a trend following strategy, which I'll show you that here in just a second on not NASDAQ, but the S&P, because we have a really good example of that. You're going to come down and you're going to test the fair value gaps more likely than you're going to actually get inside of the order block. So you have to, that's why we have both the fair value gaps and the order blocks showing. Now, if you don't want the fair value gaps to show, you can turn them off, okay? You can go to the standard engine inside of the settings of order blocks suite, and then you can click standard, okay? Standard there's no fair value gaps, or what you can do is you can come back down here to FVG box styling, and you can simply click show fair value gap boxes and turn them off, okay? That's all you have to do. And as you can see, the fair value gaps disappeared. That's all you have to do, okay? So obviously I leave them on, especially in trending markets, you leave them on. And I'm gonna show you why. We're gonna go to the 5-minute chart on the S&P, and I'm going to show you how you catch trending markets. Okay, it's very simple. It's not super hard. Okay, so we had the top. We know about that. Like, we had the top way up here, right? Now, there was not, like, because we were at all-time highs here, there was not a perfect signal saying like, hey, you need to be shorting here. So what can we do? Well, that's where market structure and the alpha structure suite comes into play. We knew that this was the market structure low and the market structure high, okay? That low got broken right here, okay? That shifted market structure on a bunch of time frames to a downtrend. That's where you're on alert now. And now you've said, okay, this might be the top. We're reversing. The trend is starting, and I'm seeing it on the 5-minute chart, the 1-minute chart, the 15-minute chart. Fine. Then price pushes up. Guess what it does? It creates an order block, okay, on its next move down. Look what happened at that order block. You came down, or you came into it and tested the fair value gap almost perfectly, literally within like a few pennies, right? 25 cents. And then you just rejected and went down. Same thing happened here, because this box right here, this is the fair value gap. This box right here, this is the actual order block. So if you enter here, you place your stop loss outside of the order block, and then you just target the trending move. You just keep riding it if you want to, or if you're a day trader, you just target the old lows, right? The old lows would have been right here, but I would have just kept riding the trend, right? This is a 5-minute chart. Now, this happened a second time where you came into this order block. You actually fully mitigated the fair value gap, because the fair value gap was from right here to right here. You fully mitigated it, and you actually tagged into the order block. So let's say your worst case scenario is you enter here at the bottom of the fair value gap, you place your stop outside, and boom. And then you would have been able to, again, catch the trend. This is the trend following strategy, okay? And I'm about to make a video on this and put it inside of the customer dashboard so that everybody knows what the trend following status or the trend following strategy is. Now, let's see how that would have worked out. So for this one, if you were to just sell down here at the first massive order blocks set, that was your first target, because there was an order block set right here. Okay, that was your first target. When you're entering, You're like, okay, where am I going to exit? Well, it's very simple. You enter on the order block and you target the next big order block set below you if you're shorting, or if you're longing, you're targeting the next big order block set above you. Very simple. If you would have entered this trade, you would have had a 19x risk to reward. Now, you're probably wondering what that means. 19x risk to reward means for every $100 that you risked, you made $1,900. That's big money, okay? That's not poo putt. You risked $1,000. You made $19,000, okay? And what do I mean by risk? I don't mean your position size. I mean how much money you lose if you get stopped out of your trade. That's what risk really is. It's nothing about your position size. We'll talk about that here in just a second. I want to talk about the trend following strategy, okay? Now, let's say you didn't get this one and you're like, you know what? I'm going to wait until we get the continuation structure and we got to break these lows and then I'll enter. Fine, perfectly fine. Because guess what? You got your entry right here. And we're going to zoom in and we'll drag this down to where it's at the fair value gap instead. So the fair value gap was right there, okay? Let's say you entered there, you placed your stop loss outside, just like we always would say to do. And then you, again, targeted, well, now I got to scroll over just a little bit. And you targeted the next order block down, 13x risk to reward. Ultimately, the bottom of that order block would have been a 16x risk to reward. You would have made anywhere from $1,300 to $1,600 per every $100 that you risked on your stop loss, okay? And that's just trend following strategy right there. But let's say that you didn't get in on that one. That's perfectly fine. There was a third one that happened right here because there was an order block, but obviously that order block got fully mitigated right here. If you would have taken this trade, this was still a 5.5x risk to reward trade, just taking it down to that order, the next order block that was down, that was still here at the time, okay? Now, if you're wondering, can I see the old order blocks? Yes, you absolutely can, my friends. We don't hide anything from you. Come into the order block suite by Alpha Intelligence, scroll down to historical/mitigated order blocks, OBS, and click the button that says show historical order blocks. And look at that. You see those order blocks that I was talking about? There's one right here. There's one right here. There's one right here. This is the order block that we just mitigated. See what I'm saying? This is why you use that setting, because it's, if say that, you know, you didn't catch the move. Well, that's fine, because look, now you can see that was your entry. You can see the order block right there where it was created. And look, boom. It's that simple. It's that simple. And then you just start moving it down, and then you just start trailing your stop. That's it. You just trail your stop into profit. It's literally that simple. We don't want you to be in danger, which is why your portfolio, right? Which is why we have all of these different strategies, which is why these indicators come with very clear entry, stop loss, and exit criteria, right? So that is how you're going to catch the trend. But let's assume you didn't catch the trend there. It's perfectly fine. It happens, man. Sometimes you don't get it. You could have caught it here. It came within, 25 cents of the fair value gap, but you definitely could have caught it yet again right here. Massive order block set. And this gets into the really good strategy, okay? This gets into the really good strategy. When you see the triangle come inside of the box, that is like your best case scenario. And guess what you're targeting? Well, if you enter right here at the order block, or let's say you enter here, no big deal. You place your stop loss right up here, and you're targeting the next order block set down. Let's show you how that trade would have played out. Say you entered all the way down here, right? And say you didn't even get a great entry. Because I'm going to assume that people aren't getting the best entries, right? 2x risk to reward would have been right here. Right around there, you would have gotten a 2x risk to reward, meaning for every $100 you risked, you made $200. Now, you would have gotten front run. You would have gotten front run here, which is why I always tell people what you have to do is when you're getting into profit, your stop loss doesn't stay up here. You don't move it to break even. You trail the stop loss down into profit. That way, if your full take profit doesn't hit, guess what? You've already trailed your stop loss all the way down right there. And when it moves up, fine, I'm cutting the trade. I get out profitably and I get stopped out in profit when this happens, right? And you got front ran by like it was like $1. It was literally like $1. Absolutely insane. Crazy, crazy, crazy. So in any case, that is the trend following strategy in a nutshell. Okay. That is the trend following strategy that I was talking about. That when markets start trending, you can use the order blocks to get in on those trends. What is your confirmation? Your confirmation is alpha structure, confirming that the 1 minute, the 5 minute, the 15 minute have started to reverse the trend, whether it's up or down, right? And starting to align with the long-term trend. Then you can start looking for those breaks of structure or the market structure shift, which we'll talk about in just a second. And you can start catching those trending markets, okay? And you use the order blocks as your entry, your stop loss, and your exit criteria, okay? Now, I'm gonna run through the comments section just really quick and see if people are saying anything. Banking profits with Drew, tax pro advisor. Dude, you're a legend. I like you, man. You're awesome. You always show up and I appreciate you. Can I discuss more about trending? Bang, dude. Like fortune teller Drew, right? Yeah. Also the different time frames and how to use the actionable information, uptrend, downtrend. Yeah. I think I covered that pretty well. Let me know if there's anything that you're confused on. We're going to move on to the next topic, which will be alpha structure, which will talk about the trends a little bit more. We are going to crash big time. The riser with the peanut butter. Watch the big rug pull to 50K. What's going to 50K? Bitcoin? Bro, I will literally bet you a kick in the balls that Bitcoin doesn't go to 50K. You can kick me in my balls if it does. It's not going. And the reason why I know that is because I know the statistics and the data on the chart. Hey, Drew, can you talk about your personal preference and the pros and cons of allowing doji candles to appear for order blocks? You get more order blocks, but unsure how much is signal versus noise. Yeah, dude. Yeah, let's check it out. All right, so let's okay, so first off, let's define what is a doji candle. Okay, so a doji candle looks something like this, where it has like a really short body, kind of looks like a plus sign, right? This is an indecision candle. This is telling you like nobody really won, whether it was bulls or bears. Now, this is where it comes into decision making, okay? And this is why I don't have dojis automatically chosen, because people need context behind the doji. And if you don't understand doji candles and what they're telling you, then you shouldn't have them turned on. If you see a doji that's like this, that's an indecision candle. That one's probably okay to use for your order blocks, okay? But one thing I want to show you is this. There are other dojis that are going to look more like this, like Thor's hammer sitting down, or what is called the dragonfly doji, which is a it's like kind of a bullish pattern, and this one's more of a bearish one. Now, for this doji right here, where price is all the way down here, what it's telling you is that they tried to rip price up, but there was too much selling pressure and the candle closed way down here, okay? Meaning there was a bunch of selling pressure. This type of candle is what you would want to see at near-term tops, okay? Now, the opposite of that. This is what's called the dragonfly doji, right? Or, you know, Thor's hammer when he's holding it up, right? Something like that. This is where it's telling you they tried to push it down, but there was too much buying pressure and they pushed it up. This kind of candle right here, you want to see this coming at like near-term lows, okay? So in the context of that, when I'm looking at a doji like this, I want to see this up here, because that's going to show me a really good bearish order block, okay? And for the other doji, one that's like this, I want to see that up down here, because that's going to show me like a really good bullish order block, because I can tell that the bulls won that candle, right? And then for any other doji, if it just looks like this, that one's going to be fine, because it's not choosing a direction. And as long as that big displacement candle comes in afterwards, and then you get the other, you know, like small candle right here that creates the fair value gap, right? Then I would be okay with that being my order block. So how do you do that? All you got to do is you got to come in here and you click allow doji as order block candle. Does that really, who was that asked? E. Hopkins. Hey man, does that like answer that for you? I feel like that was a pretty good explanation of exactly how I would, look at dojis. You're going to have to understand that when you've got those dojis turned on, you're going to have to look at the order blocks, okay? And understand if there's dojis on it, okay? So that's for more granular control. Straight out of the box, you're not going to have dojis on, but here's what I would want to do, okay? If I'm turning the dojis on, I don't really care as much about the actual candle itself. Obviously, I don't want a bearish doji coming in as like a bullish order block, and I don't want a bullish doji coming in as a bearish order block. That's all my criteria really is. And I just showed you what a bearish doji and a bullish doji looks like. What I'm going to pay way more attention to than anything is the volume that came in at that order block. This is the thing about order blocks, okay? And the indicators, and this is why they show it to you. The thing that matters the absolute most, okay? Let me answer your question first. You should. I'm not saying that I do because I don't use the dojis. You can see it. I didn't have it on my chart. Most of the time, I don't use the dojis. But say you're on like a 5-minute time frame. Check it on, bro, because then you're going to have a granular view of it. But are you going to be using dojis on a one-day chart? Maybe, maybe not. But when you've got 20 order blocks on your chart, are you really going to zoom into every single one of them? No, you're just going to pay attention to what I'm about to tell you, right? Volume. That's it. And the volume is right here. It's first off, it's in the labels, right? Second off, it's in the confluence bubbles too. This is telling me there was 321,000 contracts that got traded at this exact price point. That's a ridiculous amount of institutional volume, right? So I know that this is going to probably be a bounce point, or at the very least, price is going to slow down here. So even if this is, a doji candle, I don't care, because what I'm looking at is volume and the velocity that volume came in. So 321,000 cumulative volume in futures contracts on the S&P traded here in 1 hour. 1 hour. At most, it was 3 hours. That is a crap ton of volume that came in at that level. So that's telling me this is a huge level of institutional interest, but that doesn't matter. It could still fail. And that's exactly why we have the strategies the way that we do. You enter here and you stop out under it. Well, why? Why would I stop out? Because there's nothing in between here and here that tells you to stay in that trade. And then you just enter and you stop out outside of it. Well, why? Because if we blast through these, there's nothing here to hold us up until we get down into this order block set. So you enter here, stop loss outside of it, and at one point or another, you're going to get your bounce. At one point or another, you're going to get your rejection, right? That's why risk management matters so much, okay? In that same exact sense, okay? Say that you took those first two trades that I showed you and they both lost. General rule of thumb, you only risk 1% of your account per trade. What do I mean by that? If you risk 1% of your account, you are only going to lose 1% of your account if you get stopped out of your trade. So for example, if I have a $10,000 portfolio and I say my risk is 1%, that doesn't mean I'm taking a $100 position, because that's what 1% of $10,000 is, right? That means that my position will only lose me $100 if I get stopped out. That's your risk. Your risk is what you're losing, not what you're putting on the line. That's the whole point of a stop loss. I could put $100,000 on the line, but if my stop loss is $100, I can only lose $100. See what I mean? So by understanding that your risk is 1%, say you lose the first two trades, right? Okay, fine. I lost 1% on both of those trades. I lost 2% on my account. Did that take you out? Absolutely not. But on that third one, where that big order block set was, you actually win, and you win 4 or 5x risk to reward. Guess what? You just won 4 or 5% on that last trade, meaning 4% minus 2% that you already lost. You still came out in the green by 2% across 3 trades with a friggin' 33% win rate. Imagine the statistics when you have a 50, 60, 70, 80% win rate. You can literally have a 20, 30% win rate with this and still make money, so long as your risk to reward is dialed in properly and you're not emotional about things. That's the whole point of these indicators. These indicators remove the emotion because it gives you the exact place where you are wrong. And it doesn't mean that you're wrong. It just means that the institutions are giving that level up. You got to realize you are the 5%. 95% of the volume in the market comes in from institutions and their algorithms. You're 5%. If you only own 5% of the company, are you going to be able to go in and sit down in the chair of the CEO's position? No, dude, no. Because you're not the CEO, you only own 5%. The dude that owns the 95% sitting there. Know your place, right? I know my place. I know I'm a peon. I know I'm a poo putt. I know I'm a little tiny guy compared to these 95% institutions that move trillions of dollars through these markets every day. By understanding that you aren't actually necessarily wrong, the thesis is wrong, okay? It's not you saying, because we don't care whether or not price goes up or price goes down. You can make money both ways. I also don't care if I'm wrong, because so long as I am right bigger than I am wrong. So for example, with our 33% win rate, as long as you're winning 4x risk to reward, you're making money. As long as you're winning 3x risk to reward, you're making money because you lost 2% on your first losing trades, your first 2 losing trades, and then you made 3% on your last one, meaning you took a net gain of 1% that day. Fine. You don't have to win every trade, but the higher your win rate goes and your risk to reward stays the same, dude, you start absolutely crushing it, okay? But you need to understand you have no control over these markets. So don't take it personally if you're wrong whenever you lose a trade. That's like being like, oh, well, the company that I only own 5% of didn't make the decision that I told them to make. Well, yeah, because you only own 5%, right? The institutions own the other 95%. They're the ones making the shots. They're the ones taking the calls, taking the shots and making the calls, okay? You're not. So what you do is you track them and you understand they're going to push the market wherever they want, but you know where they're positioned. You literally know where they're positioned. So you know that they're highly likely to bounce the market here. And even if they give this level up, they're likely to bounce it here. And even if they give that level up, dude, they're probably going to for sure bounce it here, is my point. Why? Because they did it in the past. This is exactly where they positioned. It's not guesswork. This is exactly where they positioned. They built massive positions here in the past. Way back here. Look at that. Before this massive pump, that's where they built their positions. You wonder why we're stopping here? It's cut and dry. It's very cut and dry. You tagged into the fair value gaps of this and then bounced. It's that simple, okay? So hopefully that kind of like helps people understand not market structure, the order blocks suite and the fair value gaps, and when you're using the fair value gaps and why. Right? Because you're usually only using fair value gaps in trending markets, right? The fair value gaps are there. And if it's a super tight range, yeah, you go ahead and just enter at the top of the fair value gap and then put your stop loss outside of the bottom of the order block. Totally get it. That's a game time decision, because when you have a massive fair value gap and a really tiny order block, I would not suggest entering at the top of the fair value gap. See what I'm saying? Yeah, that helps. Appreciate it, bro. All right, cool. Let's look at what we got left. Where is the risk to reward tool calculator? What do you mean? You talking about this thing? I don't know what you're talking about. You talking about this? That's just the position thing, dude. That's the long and short position. It's inside of this thing called forecasting, okay? You're going to have to calculate your own risk to reward, like, because this thing doesn't know. Like, our indicators don't know how much money you have in your account. So it's like if you got $10,000 in your account and you're like, oh, I want to risk 1%, you just got to do the math. And you got to say, okay, when I set up this position, if I'm only willing to risk 1%, then I can only take this amount of a position, okay? I don't understand this question, Hazardous. How do I set the order block shaded areas to the left of the candles? You don't. You don't. Like, because that's not how it works. Why would we extend it this way? That tells us nothing. What this is telling us is exactly where that order block came in, and it's extending it to where price is in time so that whenever you visit it, you can see it. If I extended this all the way over here, it would make my chart look crazy, right? The only ones that are extended left are like these ones down at the bottom that haven't been hit yet, and it's just because they were created all the way over here. But as you can see, after they're created, they only extend right. They never extend left, right? So yeah, hopefully that answers that question for you, dude. Let's get back in here, check the comments, and then we'll move on. Left. Please cover break of structure and swing failure patterns. All day, bro. Easy, easy money. Okay, so I'm going to tell you what a break of structure is, and then I'm going to tell you what a swing failure pattern is. I'm also going to tell you what a market structure shift is, and Chach if you want it, right? So, okay, essentially, I don't use Chachas, by the way. I don't use Chachas. It's either break of structure, market structure shift. There's highs, there's lows, there's swing failure patterns, and there's phantoms. Phantom highs, phantom lows, and the phantom highs and lows, they only come when there's a swing failure pattern. So it's break of structure, market structure shift, swing failure patterns. That's it. And then you've got your confirmed highs and your confirmed lows. That's all that it is, okay? A break of structure, and I will show you this on the chart. Okay. Actually, let's do market structure shift first, because I think that's pertinent, because most people don't know where trends change. So a market structure shift, let me come back on screen just really quick. A market structure shift is when the trend reverses from either a uptrend to a downtrend or from a downtrend to an uptrend on that chart time frame at a very specific place. The only way that that can happen is on a candle close. So say you're on a 1 hour chart and you're in a downtrend. Your 1 hour highs can only be broken and shift the trend back to the upside, to an uptrend, shifting it from a downtrend to an uptrend. The way that that happens, it's called a market structure shift, is you come up to the high and you close a candle above that high. That is a market structure shift where the market structure has shifted back to the other side. So, and I'm going to show you what that looks like. Okay. So this is where our market structure shift happened. And you're probably like, Drew, that doesn't make sense because there's no candle over here. I'm going to show you why it's like this. And this is why I'm going to explain it to you, but this is why you don't question the indicators, because they know and you don't, and you don't have to. And neither do I, but I do because I coded them. So I'm going to show you. This was our old market structure high right here. I know that because I am the one that coded the indicators and I understand market structure. This was my market structure high. Now, what happened is you swing failed that high. That's what these little triangles are that are pointing down. That's telling you that there was a swing failure pattern of the 1 hour highs right here on this candle. Now, what is a swing failure pattern? It's the opposite of a market structure shift or a break of structure. The swing failure pattern basically says, hey, we wicked above the prior high, but the candle came back under it and closed under the prior high. So what does that do? It actually moves the high, right, to here now, okay? And then guess what happened? That high got another swing failure pattern that happened right there. So what did that do? It moved the high, okay? And then that high got swing failed again right here. And guess what it did? It moved the high. So now do you see why the market structure shift line is right here and it connects to the last triangle? Because you had 3 swing failure patterns that happened in between your old high and your new high. And then guess what finally happened? You closed a candle above the high. That, my friends, is a market structure shift, okay? Now, we are in an uptrend, okay? And again, you don't have to know all of this. The indicators already know it, but I want people to understand why this is the way that it is, okay? You can see what the trend is right over here on any given time frame, right? Which is, you know, pretty awesome. But we're going to turn we're going to turn order blocks off for this. If this is our new high, okay, we are in an uptrend, okay? what is going to have to happen is we'll probably come down here, we'll print a couple of, pink candles, whatever. And then as soon as we come up here and we close a candle above that high without swing failing it, obviously, because we know if we swing fail it, there will be a new high that we need to then crack with a candle close. That is what is called a break of structure, because the structure is up here. This is your structural high. You're breaking that, and that is what is called a continuation pattern, okay? So market structure shifts are reversals. Breaks of structure are the continuation pattern. Now, be that as it is, there's one criteria that has to happen on the break of structure. In order for this break of structure to be valid, this is your high. You cannot come down here and close a candle under the 1 hour low, because if you did, guess what? That's a market structure shift, and now you're back in a downtrend, okay? This would still be your high, but if you've shifted to a downtrend here and then you close a candle above that high, guess what it is? It's just a market structure shift again, back to the upside, right? So my point in saying this is, if you're going to break this high and get the break of structure continuation uptrend, you cannot close a candle under the 1 hour lows that are down here, okay? That's what a break of structure is. Now, the swing failure patterns happen, and this is a really good signal of reversals, but there has to be context on that swing failure pattern, okay? The best swing failure patterns happen whenever there is an opposing divergence, okay? So let me show you. So if these are bearish swing failure patterns, meaning it's pointing down, it's pointing to a reversal to the downside on the 1 hour chart. What's that telling me? It's essentially telling me to short, right? That's why it's pointing down, okay? When you see that pop up, what you really want to see is this. Is there a divergence happening? Because if there is, you are going to be a lot more likely to actually get a move down or in the proper direction. And you did, barely, right? And this is why you have to trail your stops, because whenever you're swing failing in a massive uptrend, it is not likely that you're going to get like this massive move down. You're probably going to get a tiny move down. Now, if you look at these two swing failure patterns, did we have a bearish divergence on either of these swing failure patterns? Price was going up. Here's what RSI was doing. Going up. See what I'm saying? It was going up. So there's no swing failure with a divergence there. That is what would have kept you out of these trades and getting stopped out and not profitable by just doing that one check. Hey, I'm going to look at RSI. Okay, this one looks good. I'm going to enter, but I'm just going to trail my stop to break even as soon as I get in. Why? Because I'm in a 100% uptrend right now. Now, the trend does have to reverse eventually, and I totally get that. But this trend literally just started like 4 days ago, right? This is not a trend that's been trending for 2 months. This has been trending for a week. You know what I mean? Like we were at $4,000 last, like, what was it? 2 weeks ago, 3 weeks ago, tops. This trend really started right here and right here, okay? That's why those swing failure patterns matter, but you have to be very cognizant of the swing failure patterns, because that doesn't mean that you're going to get this massive move every time it prints. You might get a really small, tiny move like you did here because you're in this massive uptrend. Or if you don't have the opposing divergence, then you're probably just going to get stopped out like you would on these two. But by understanding that there was no divergence on these two, it kept you out of the trade, right? And the same thing here, right? Look at this. You got a swing failure pattern happening here, and you got a swing failure pattern happening here of the lows, right? These were your lows. Price is trending down, right? Look at this. Price is trending down. What's RSI doing? Trending down. See what I'm saying? That's not a divergence. You would have needed to see RSI trending up, not down. That's what keeps you out of the false signals, okay? That's what keeps you out of it. So by understanding what a swing failure pattern actually is, and then understanding that you're not just going to take the trade every time a triangle pops up. You're going to look for the divergence, especially if that triangle is not popping up like this inside of the box, okay? Inside of the box. That's why those won, okay? Because it was popping up inside of the box. You didn't have to have the divergence, but guess what? You did. And this is the perfect trade. This is my perfect bread and butter setup. Your highs were getting higher. Your highs were getting higher. And look what RSI was doing at the same time. Bang. And then you see how that played out, right? Let's zoom in. I'll show you. Let's just take this one into account. So these swing failure patterns right here, this is a very easy entry, okay? You just enter after the swing failure pattern happens, okay? You have the order blocks up here, so you have two different ways that you can place your stop. You can either place your stop outside of the wick of the swing failure pattern, or you can place it above the order block, knowing that you could get ripped back up into the order block. But if you watch, you have the divergence. And guess what? You got your push down. You really did. You did get your push down. But what was more powerful? The swing failure pattern that didn't come inside of the order block, or the swing failure pattern that had a longer term divergence that came inside of the box? Well, look at that. It took you down to the absolute bottom, right? That is probably the best strategy that you're going to have, period. Triangle comes inside of the box, opposing divergence, right, is the best case scenario. This one, it didn't get the divergence. Right here, you got the triangle inside of the box. You can still absolutely enter and target your next box up. But what would have been even cooler is this was your old low. If RSI was down here and then it was right here, that would have been your textbook bullish divergence. That would have made the trade even more like probable to play out, okay? Very similar to how it was back here. You got this divergence from the lows, and as you can see, long-term divergence, bullish, went up, right? Then you got another one right here, again, another bullish divergence, right? And then again, it pushed up again. See what I'm saying? So by coupling the divergence with the swing failure pattern, and then potentially coupling that with order blocks, dude, it's going to keep you out of so many bad trades. And that's what this system does. It removes your emotions. It keeps you out of those bad trades. That's the name of the game, guys. It really is. Take the high probability setups. And now you don't have to watch just one asset. Say there's no trade. Say you watch the NASDAQ. There's no trade on the NASDAQ. Who cares? Go over to the S&P. Because now, watch this. You have the full methodology, right? I'm just going to say, okay, I don't see a trade on NQ now because we're stuck in between these two order blocks. Screw it. I'm going to go to platinum. And watch. 1, 2, 3, 4, 5, 6, 7. 7 seconds it took me to know the full market context. And now I'm like, damn. I missed this trade, the triangle into the box. That sucks, right? Triangle straight into the box. Perfect divergence. That's short city. This is my target, right? My point is that I can flip through 20 assets in 5 minutes and go find a trade somewhere else. Maybe I go to, natural gas. I don't know. Maybe there's a trade on natural gas. We'll see. We'll know in 5 seconds. We'll know in 5 seconds because it's going to plot all of it for you. So in any case, actually, there is a trade. You're smacking into the order block right now. You could enter here. Your stop loss is outside of the order block. You target the 1 hour lows, and right there. It's not the highest probability setup. You would like to see the swing failure pattern happen there with the divergence, but it's not required. You can still enter here, place the stop there, target there. That's perfectly fine. my point is that removing the emotions and removing the guesswork from your strategies, that's what this indicator does, or what all these indicators do. And what they also do is they stop you from entering stupid trades and then just taking BS trades that you might not normally take just because you want to get a trade that day, right? Instead, what you can do is flip through 20 assets and find the perfect trade. Because now you don't have to manually chart anything anymore, and you're basing it off of the data that the institutions showed you, okay? So, yeah. Okay, so for the indicators, the way that the confluence lows and highs work, let's go to gold, because this is a really good kind of understanding. So you can see these market structure little like bubbles, right? And it says MS on it, okay? What that's showing you is that there are 4-hour and 1-hour lows at the exact same price. So basically what it's telling you is that if you break this level, you're not just breaking the 1 hour to a downtrend, you're breaking the 4-hour to a downtrend, okay? So when you're taking trades, say you come up here and you get like the swing failure pattern inside of the box up here at the 1-hour highs, your logical target is either going to be whatever order block is closest to you next, or the same time frames opposing highs or lows. So if you're shorting to the same time frames lows, and if you're longing to the same time frames highs. That's what a swing failure is telling you. It's swing failing, it's faking you out at the lows to then rip you back to the highs, and it's faking you out at the highs to rip you back to the lows. See what I'm saying? That's what a swing failure pattern is. Now, what's really valuable is knowing where all of the highs and lows all congregate together, because when there's more highs all at the same exact price point, it's going to be a harder level of resistance to get through. That's all that means. The more that is stacked at that level, the more the cards are stacked against you. Look at them as walls, right? Like, what seems easier to get through? If I'm like right here, what seems easier to get through? This one little thing right here. But what if I'm up here? Does this seem harder to get through? It's like, damn, I got to go through this. Oh, finally I'm out. You know what I mean? Like, that's why the confluence highs and lows matter so much. Okay. So just do with that information what you will. Why do they leave their order blocks open for such a long time? No one says that they do. No one said that they did. No one's saying that they leave their order blocks open for a long time. If you want to know that, you can go to the live tape, but the live tape is going to rip you around, and they're going to show you a bunch of fake orders, and they're going to spoof you. That's what the algorithms do. They put a big block of orders somewhere. That's not what this is showing you. This isn't showing you, oh, here's their orders that are pending. It's showing you here's where they actually bought and sold, right? It's showing you where they positioned previously so that you can predict where are they going to position again in the future? Where are they going to defend the positions that we know for a fact that they already bought or sold? And where is price likely to slow down and reverse? Because we know that they were, in the past, very comfortable buying or selling at that price. So what do I know? Well, give me 1 second. Let me show you something. If I know that these guys were super happy to buy at these levels in the past and rip price up, right? What is the difference in the market that has changed fundamentally that tells me that they're not still happy to buy at that exact same level once price returns? Because they were probably legging out of their position here, and now they're happy to take that trade all over again. See what I mean? So it's not showing you like the live order books. You can't do that on TradingView. It's impossible. It's literally impossible. You can't do it on TradingView because it's Pine Script. If you want the live tape, you got to go buy the live tape, right? Which is very expensive. But one thing you have to remember is that even if you do have the live tape, orders can be spoofed. Orders can be spoofed. I can go out and put an order on the order books right now at say $7,700 on the S&P that's worth $500,000, and people will be like, oh my God, this guy's ready to short at $7,500. And then they're like, then they pile into shorts because they're like, okay, that's like somebody big here is telling us to short, or longs will pile in to then sell into that level and take the profits, right? Here's the thing. As fast as I can put that order up, I can take it off. So then I rip price back up. Whole time I've already been long. I'm spoofing that order to then coax people to take price up to that level. Boom. That's what the institutions do with the live tape. That's why I rely more heavily on what I know for a fact that they've done, not what they're telling me they might do, right? That's what order blocks does for you. So based on these order blocks, should we wait to load up on silver? Warren, I can't give you financial advice, bro. I feel like silver will move with gold. Silver will move with gold. Silver will move with gold. I'll do the TA for you, but I'm not going to tell you to wait, or you got to make that decision for yourself, dude. One thing I'll tell you, if you lose this level right here, 67, 78, you're coming down to about 64. That's just what the order blocks say. What I would like to see is a swing failure pattern that happens right here. We run through this order block. We get the swing failure pattern with the divergence, right? And then we long it. We come into this, and you're going to receive massive, massive resistance here. Why? Because we know there's $1.6 billion in short positions that happened there in the past. So if their positions are still there, guess what they're going to do? They're going to defend it. If their positions aren't still there, guess what they're going to be doing? They're going to be very happy to just take the positions all over again, rip it back down before they come down here, load up again, and then start taking it long, right? So that's kind of the skinny on silver. Now, I want to go over two other things really quick. No, that doesn't imply. Okay, let me read the comment. You mentioned how much it costs to hold a silver futures contract over the weekend or overnight. Doesn't that imply we are actually looking at open orders? No, it doesn't. Just because volume happened somewhere does not guarantee that that volume is still there. It does not guarantee that that position is still open. All it guarantees is that $1.6 billion worth of shorts came in right there at that exact price point in those exact time frames. That's all it guarantees. So no, it doesn't imply that at all. Categorically, no. Nice. Izzy works. Appreciate you. Okay, now we got to talk about two other things. Okay, two other things. Naked levels. Okay, there's naked VWAP and there's naked point of control. What you're going to want to understand about these are not. I mean, you can base your strategy around them. A lot of people have just straight up VWAP strategies. I have one inside of your customer dashboard. Feel free to go in there and check it out if you have access to the indicators. If you don't, you know, $7, you can get access to the indicators and you can go and get these strategies. I do have a VWAP strategy in there. I do have a volume profile and POC strategy in there. Here's the two things you need to know. VWAP, volume weighted average price. All it tells you is that in a certain time period, whether it's daily, weekly, monthly, 3 month, 6 month, 12 month, whatever, in that time frame, it's telling you this is the moving average of moving averages. This trumps all SMAs, all EMAs, anything, okay? MACD, all of it, trumps all of it. VWAP tells you the average price of all of the volume that came in to that particular market on that particular time frame. Now, if it's a daily VWAP, it's just showing you the average price for the day, okay? That's all it's showing you. All right, so give me 1 second. I'm actually going to bring this up. Naked VWAP suite, okay? We're going to bring this up on the chart. Now, there are things called naked VWAP levels, okay? And basically, it's telling you where the institutions were positioning yesterday, okay? This is a naked daily VWAP. VWAP resets every single day because it's a new session, okay? And what this is telling you is the average price weighted by the volume that came in, 223,000 contracts in volume, we're at an average price of $4,492. So whenever you come back down to these levels, it's basically telling you, like, say you came down to this level, that's essentially where the institution's average price was yesterday. They're very likely to defend that level when they return to it, okay? Now, you can use an entire strategy based off of this and based off of VWAP, but I use it as confluence, okay? So say that we have like order blocks that are here. I'm going to use this naked VWAP level as confluence where that order block is, right? So for example, you have order blocks right under it. You might come down, take that VWAP level, tag into the order block and move up, right? You also have a naked VWAP right here and then an order block level. You might come through that naked VWAP, tag into that order block and move up. The best case scenario is you have an order block right at the VWAP, the naked VWAP, and then you come down, test the order block, hit the naked VWAP, and you move up, okay? The reason why these levels matter so much is because that's where you see price reactions, price reversals. You see price going back to those levels, smacking into them, and then going, right? Period. It happens all the time. Now, that doesn't mean that they hold up every single time. Obviously, the higher the volume on that level, the more that it's going to matter, because that's the more institutional positioning that was at that level, right? On average for that day. Now, a weekly VWAP, naked VWAP, is going to be more powerful than a daily. Why? Because you have a week's worth of data on that. So if you've been accumulating something at an average price of like $50 over the past week, and then you're an institution, you got big money, and price returns to it back to your $50 price point, what are you going to do? You're going to buy the crap out of it again to push it back up, and you're going to defend your position, right? So why? Because you built that position over a week. You're not giving it up without making money off of it. These are institutions with unlimited money. They're not going to do that, right? They're not like us. They don't have to enter like we do, where like we pick the pinpoint entry and like we got to go kill it with it and make money. They don't have to do that shit. So anyways, my point, whenever you return back to those naked levels, a lot of times you'll see those bounces, okay? There's a second naked level that you need to take into account. That is called the naked POC. The naked POC is called the point of control. Now, I'm going to pop this up on the screen. I'm going to show you what that means, all right? So the naked POC level, we're going to take order blocks off for now. The naked POC levels, dude, I mean, you've got a naked weekly POC right above you. Literally right there. Literally right there. It goes all the way back here. It goes literally all the way back to here. That's insane. That's where they were positioning way back here. They took a bunch of short positions at $4,705. So what's the difference in between the naked POC and the naked VWAP? VWAP is an average price of all of the volume that came in during a particular session. The point of control is the exact price point that the highest amount of shares traded at during that session. So think of it like little volume bars, right? I'm going to actually show you what it looks like. If you give me 1 second, I'm actually going to show you what this looks like on the chart. All you got to do is come down here and turn on your volume profiles. So I'll turn on the daily volume profile. It's the histogram. Watch this. See these histograms? What these are telling you is the exact volume that came into the market, okay? So these little bars are telling you exactly the volume that came in. The smaller the bar, the less volume came in. The larger the bar, the biggest amount of volume came in there. So as you can see, the largest bar is always the point of control, right? So this is a naked daily point of control right here, okay? And that daily point of control is where the exact price point where the most shares were traded in that day, period. That's it. That's all it means, okay? So that's essentially all you need to know about the naked points of control and the naked VWAPs. Whenever those levels come in at the same time that price is testing order blocks or market structure is shifting and you've got swing failure patterns happening there, that's substantial evidence that a reversal might be happening. Because think about it from the institution's perspective. It's very similar to VWAP. if you bought a crap ton of shares at 50 bucks yesterday, and then it pushed up to 52, and then the next day it comes back and it goes down to $50 again, what are you going to do? You have unlimited money. You're going to buy the crap out of it again and push it up and then go get profitable on it, right? Because you're the institutions. You run the market. You do whatever you want. That's why the naked daily point of controls matter, because when you revisit them, they are very likely to reverse and bounce or reject from that level because they're defending their positions that they built there. You can have a naked point of control on, you know, a session. You can have it on like the Asia session, the London session, the New York session, even the kill zones. But I usually look at the daily, the weekly, and the monthly points of control, and that's it. That's it. That is the indicators in a nutshell, my friends. We're not doing, we're not taking requests, man. It's we're already over by 10 minutes. Show up to my stream on Monday, or actually just go back to my stream that I just did at 10:30 a.m. and you'll see all of the gold analysis, all of the gold analysis. Let's see what this guy said. Nathan C. That makes sense. Then roughly these levels are the indicating where there is likely to be the most amount of eyes on the chart from the previous traders. Levels of trade then indicate likely actions. Yeah, pretty much, bro. Like, it's just literally laying out support and resistances, and it's laying out the actual institutional footprint of what they have done. Not what they say they're going to do, not what the news is saying is going to happen, what actually happened, right? All these other indicators, they tell you what happened in the past. Our indicators are going to tell you what's going to happen in the future, right? So by understanding what happened in the past, see what I mean? Because we know where the likeliest bounce points are. We know where the likeliest reversal points are. We know where the institutional money has guaranteed bought and sold in the market and positioned. And we know where they're going to be likely to either, one, defend their position, two, reopen their position, or three, add to their position, right? Or they're already out and they just let the position go, right? So, man, let me know if that's helpful. Hopefully that's helpful. We do this every single month for the indicators. If you subscribe to the indicators, you can always ask questions inside of the Discord, like anytime, any day. But if you want like a live demonstration, dude, save that question and bring it over here just like all these other guys did. And I will literally teach you and train you. My one public service announcement. If you have not gone into your customer dashboard and watched all of the trainings, all of the strategy videos that we have in there, all the tutorials, and got like trained directly from me, please do so. Seriously, please do so. It will make you so much better of a trader with these indicators, okay? I appreciate you all so much. Happy Friday Pi Day. Happy trading. Everybody have a wonderful weekend with your beautiful families, and I will see you all soon. I will definitely be doing another stream on Monday for TA, where you can come in and ask me to do TA on whatever asset that you want to do. If you haven't gotten the indicators yet, just know you can try them for $7, okay, for 7 days. It's not a huge commitment. You do not have to commit. You can try them, get in, take the trainings, go and check them out, figure it out for yourself. Yeah, man, I do understand ICT concepts. And actually just one other quick thing that I want to show people before we sign off. By the way, let me turn this off and turn this back on. This is going to blow people's minds. Most people don't know this about the indicators. Let's just zoom in. So alpha structure, okay? You can come into the settings and you can actually put it on ICT market structure and watch what happens. Just give it like a couple of seconds. Bang. Now you have ICT market structure. Obviously, in my opinion, my market structure works better. It's called alpha structure. Alpha mode is way more reliable than ICT. But hey, if you want to trade ICT, go ahead and do it. You can do it with the alpha structure. It's got both modes. So this, like I said at the beginning of this video, these indicators, and I've proven this a million times, They work on every time frame. They work on every asset. They work for every trader type, whether you're a scalper all the way up to an investor. They work with any trading strategy or any trading style. You trade SMC, ICT, VWAP, volume profiles, freaking support and resistances, supply and demand. You trade any of that, they work for you, man. So there's not a single trader in the market, unless you don't use TradingView, that these won't help. So hopefully everybody has a wonderful weekend. Thank you seriously all so much for showing up. I will see you all soon. Much love to you. And I will definitely be doing the streams on Monday. I don't stream on the weekend normally, but I will see you all on Monday. And if you haven't got the indicators, go try them out. And if not, no big deal. Just keep showing up for the streams. Peace.